Another day, another story. Hello, financial freedom seekers. Welcome back to our channel, your guide to creating wealth and securing your future. If you're new here, click the subscribe button and join us on this journey. Today, we're stepping into the vast world of investing. Whether you're completely new or just need a refresher, this in-depth guide is designed just for you. Let's begin by understanding what investing is. It's about putting your money to work in different ventures such as stocks, bonds, real estate, or even starting your own business, hoping it will grow over time. Investing can be compared to the process of gardening. In this analogy, your capital serves as the seeds you sow into the soil, representing the investment arena. You nurture these seeds by providing the necessary elements of sunlight and water, symbolizing patience and time. Over time, they develop into thriving plants, which signify the returns on your investments. Now that we've covered what investing is, let's explore some common and popular investment strategies. 1. Stock market investing. This involves buying shares in a company. When the company does well, so do you, as the value of your stocks increase. However, it's worth noting that the stock market can be unpredictable and sometimes volatile, so it's vital to diversify your portfolio. Let's discuss the concept of portfolio diversification and showcase some examples. Portfolio diversification is a risk management strategy that involves spreading investments across a variety of assets within a portfolio. This technique aims to limit the exposure to any single type of asset, thus helping to reduce the volatility of your portfolio over time. The process of diversification entails investing in more than one type of asset class to reduce the risk of your investment in the long term. It's a significant aspect of investment decision-making, particularly under circumstances of risk or uncertainty. An effective way to achieve diversification is by incorporating a mixture of income-producing assets in your portfolio. Some examples of these assets include stocks, which give you ownership in a company, mutual funds, and exchange-traded funds or ETFs. Simple, low-cost ETFs or mutual funds, particularly index funds and target date funds, can quickly and safely diversify a portfolio while reducing risk. For instance, consider you own $5,000 worth of Tesla, TSLA, stocks, which is your only investment. If Tesla's stock falls by 30% in a month, your $5,000 would reduce to $3,500, a $1,500 loss. To prevent such significant losses, diversification suggests spreading your investment across multiple stocks and sectors, not just a single stock. Now let's move to our next strategy, which is 2. Real estate investing. Another popular strategy is investing in properties, either to rent out for a steady income stream or to sell later at a higher price. But remember, real estate requires a significant initial investment and comes with its own set of risks. There are numerous ways to invest in real estate, each with its unique benefits, risks, and levels of involvement. Here are some of the popular types of real estate investments. Peer-to-peer lending and crowdfunding. These investment strategies involve putting your money toward individuals or projects you believe in, which could be real estate related. Crowdfunding involves multiple people pitching in toward one cause and can be an effective path for beginner real estate investors. Real estate investment trusts, also known as a REIT. A real estate investment trust is a company that focuses on a specific type of income-producing real estate such as hotels, apartment buildings, senior housing, and more. REITs can be an attractive option for those with less capital to invest. House flipping. This investment approach involves buying a property in need of renovation at a low price, fixing it up, and selling it at a profit. Vacation rentals. Platforms like Airbnb and Booking.com offer alternatives to traditional hotel accommodations, making owning and renting out a second or third property potentially lucrative. Long-term rental properties. Becoming a landlord is a popular form of real estate investing. Tenants sign extended leases, providing the landlord with a steady income source. Renting to own, also known as a RTO. RTO agreements are often utilized by buyers who need extra time to save up a down payment or improve their credit. If you're the one with a home to sell, entering into a well-structured lease agreement that provides your tenant with an option to buy can serve as a real estate investment. Real estate wholesaling. This involves finding a great deal on a property, locking in the price, then selling it, before you actually close, to an investor or developer. There are many success stories in real estate investing. For example, Tim G was introduced to real estate investing by his new boss. Although initially his wife wasn't too keen on the idea, after their first successful flip, she came around to the idea of real estate investing. Another success story comes from two beginners who started investing in real estate and made significant strides, showing that experience isn't always a prerequisite to success. Remember, while some types of real estate investments can reap profits quickly, most are long-term investments that require a fair amount of patience. Like any investment, real estate investments also come with some risks. Now let's move to our next strategy. 3. Mutual funds and ETFs. These are essentially baskets of different types of investments, and they provide an easy way to diversify your investments. However, remember that they usually involve management fees. Mutual funds and exchange-traded funds, ETFs, are both popular types of investment vehicles, but they come with distinct advantages and disadvantages. Mutual funds advantages. Professional management. Mutual funds are managed by professional investment managers who make decisions about which securities to buy and sell within the fund's portfolio. Diversification. Mutual funds allow investors to purchase a diverse range of assets with a single investment, reducing the risk associated with investing in a single security. Accessibility. Mutual funds typically have lower minimum investment requirements compared to purchasing individual securities, making them more accessible to a wider range of investors. Mutual funds disadvantages. Lack of liquidity. Mutual funds can only be purchased or sold at the end of each trading day at the net asset value price. This means you don't have the flexibility to trade during the day. Fees and expenses. Mutual funds often come with higher fees and expenses than ETFs due to their active management, which can eat into your returns over time. Capital gains distributions. Mutual funds might also incur capital gains distributions, which could have tax implications for the investor. ETFs advantages. Trading flexibility. Unlike mutual funds, ETFs can be bought and sold throughout the trading day at fluctuating prices, much like individual stocks. This flexibility can be beneficial for active traders. Lower costs. ETFs generally have lower expense ratios than mutual funds, making them a more cost-effective choice for many investors. Tax efficiency. ETFs are often more tax efficient than mutual funds due to their unique structure and redemption process, which helps limit capital gains distributions. ETFs disadvantages. Trading costs. While ETFs generally have lower expense ratios, trading them could incur commission fees, though many brokers now offer commission-free ETFs. Price versus NAV. ETFs can sometimes trade at a price that is slightly different from their NAV. This discrepancy can mean that investors might buy an ETF for slightly more or sell for slightly less than its actual value. It's essential to remember that while both mutual funds and ETFs can be part of a balanced investment strategy, the right choice depends on the individual's financial goals, risk tolerance, and investment preferences. Now let's move to our last strategy, which is peer-to-peer lending. Peer-to-peer lending is a form of direct lending that allows individuals or businesses to obtain loans from other individuals or businesses, eliminating the need for a traditional financial institution to act as an intermediary. This process is also known as crowdlending or social lending. Peer-to-peer lending can offer benefits for both parties involved. For lenders or investors, it can provide higher returns compared to many traditional savings or investment accounts. In investing, it's crucial to understand the relationship between risk and reward. Higher potential returns often come with a higher risk. It's essential to balance your investment portfolio according to your risk tolerance.